Hello. Thanks for joining. It looks like it's high noon on Monday, September 12th, 2022. So thanks for joining us here. We'll get started here shortly. I see a few more people hopping on, so I want everybody to be able to join us that can. And thank you for taking time out of your busy day. And it's looking to be a nice, bright, beautiful Monday here in the Twin Cities area. So I guess we'll go ahead and get started here. Today we are going to talk. I wanted to give a little market update, just kind of where things sit, real quickly. It's going to be fairly brief, and also introduce our new scorecard. We're calling it the TaxSmart scorecard. It's really slick. I think it will really help out a lot of the families that we work with, help you get a good idea of maybe if there's some gaps in your planning. We talk about complete and incomplete planning. So we'll get to that here in a few minutes, but it's really exciting. We want to roll that out and show it to everyone. So let's get right into it. First of all, our usual disclaimers. We really aren't giving much for investment advice today, but we are talking about the markets a little bit. Markets obviously are subject to change, so a lot of what we talk about is likely to change quite quickly, and it's not meant to be individual investment advice. So first of all, a quick market update, and the chat is on, so if anybody has any questions or comments, feel free to chime in at any time. Adjust this here a bit. All right. So last week we did see a bounce in the markets finally. For the 3 weeks prior, it was kind of ugly, to be quite honest. The markets, if you look at it, I mean, we hit bear market territory, really hit the bottom there in the mid to late part of June. They bounced nicely in July. We're still moving up into August, and then middle of August, it feels like the wheels kind of fell off with Fed Chairman Powell talking about doing whatever it takes to bust inflation or bring it down, even if it means bringing pain to families in the U.S. So the equity markets, some noise here. I'm going to try to fix the microphone a bit. There we go. Hopefully that's better. So anyhow, that brought the markets lower, and we did see 3 weeks of the market dropping by about 8.5%. Last week, the markets did bounce nicely. They were up about 2.5%. We've seen a big move in yields, bond yields. I shouldn't say big, but there's been an uptick. They've moved higher, and the yield curve's flattened a little bit. We are still looking at an inverted yield curve with the 2-year treasuries trading higher than the 10-year treasury on the yield basis, which a lot of times does not bode well for future growth prospects in the economy. A quick update as to where we're at kind of on a quarter to date, year to date basis. Year to date, we've seen a lot of negatives. Quarter to date, the quarter's been better. Really, it's the small caps that have done best, followed by the S&P 500 and NASDAQ's been doing quite well as well. On the 1 year basis, we're quite negative. I will point out, though, as painful as the market's been this year, that if we're going back 3 years, and these are actually annualized numbers, I should have put that in here. So on an annualized basis, going back 3 years, so 2019, right prior to the pandemic, most of the indices are higher, with the exception of the Bloomberg Barclays Aggregate. That's a bond index, so bonds have lost money over the last 3 years when the stock market's done quite well, including this year, and we can see that bonds have done poorly this year as interest rates have moved higher. To give you an idea of kind of where we're sitting today compared to where we have been, the Fed funds rate, the upper bound, is at 2.5%. That's about where it was back in 2019, 3 years ago. The difference being at the time, inflation in 2019 was running at about 2%, where today it's at about 8%. We've seen treasury yields move up quite a bit, 30-year mortgage rates move up quite a bit, oil prices move up a lot, natural gas has moved up a lot as well, and then gold is slightly higher. So what's going on this week in the markets? Tomorrow is the release of the Consumer Price Index. Current market expectations are for a year-over-year increase of about 8%, but we're looking at a month-to-month increase, actually a decrease. We're looking at prices falling from last month of about 0.1%. That's due primarily to gas prices, oil prices falling. Year-over-year core, so taking out the food and energy, is expected to be about 6%, but the month-over-month at 0.4%. So when you do strip the energy out of there, we're still looking at a rather high change on the month-to-month basis with CPI and inflation. The Producer price index is released on Wednesday, so that's going to be expected to be somewhat similar to the CPI as well. Retail sales on Thursday, we're really watching the consumer because consumer spending makes up about 2/3 of GDP growth. And so far, the consumers stayed fairly resilient. There's been some shift, though, to more of the essentials, the food and energy, even clothing, I suppose, to a certain extent, versus more of the discretionary spending. But overall, consumer spending has been robust and really hasn't fallen off a cliff or anything. Capacity utilization is a way of measuring how much of the capacity in manufacturing is being utilized. That's a good indicator of what the economy is doing, overall economic health, and that has remained very robust as well. So that's why we're keeping an eye on that. If we do see that start to trend downward, that could be a warning sign of a recession. I did want to talk about the consumer price index just a little bit to give you an idea of some of the components. We've looked at this before. Shelter makes up about 42%. That's really what I wanted to focus on today. Is everybody talks about how oil prices have moved lower, but if we go back, natural gas prices have moved quite a bit higher. Natural gas and heating oil are included in the shelter component because they're considered to be household utilities. The other part of the shelter component is that they don't actually look at home prices. They look at something called owner's equivalent rent. That is, how much would you receive if you were to rent out your home, regardless of the price of it. So even though we've seen home prices move up quite a bit over the last year, I mean, maybe there's some softening in the real estate market now, the owner's equivalent rent hasn't moved up quite as far. Let's look at a chart of this here. So this is actually an index of housing prices to rents. And you can see where it spiked back in 2006. So back here, 2007, then it fell. And so what this is showing is the ratio of home prices to rent. And it just shows that rents are not keeping up with the home price increases, which makes sense because people, if they're unwilling to pay more, landlords cannot charge quite as much. Some places are rent controlled, obviously. So what'll most likely happen is either we'll see home prices fall like we did back in 07, 08, probably be more in line, or eventually owner's equivalent rent or rents overall will have to move higher to keep up. I mean, we're just kind of looking at long-term trends here. There's nothing that says they absolutely have to. But if rents do start to move up, that would obviously cause quite a tailwind for higher inflation as well. So something we're keeping an eye on. Getting back to the question in the chat, it's a great question too. Does PPI lead CPI? PPI does. That's the producer price index. That's the wholesale prices that producers are paying, which are generally passed along to the consumer. And so when those are high, we expect to see consumer prices high too. If you remember, the PPI was at about 10 or 11% a few months ago. So coming down in the 8 to 9% range is showing that it's coming off a little bit, but still remains very elevated. Next week is the Fed meeting. So the Federal Open Market Committee, technically is what it is. It's part of the Federal Reserve. The current target range for the Fed funds, they quoted as a range now, is 2.25% to 2.5%. Current expectations, and this is what the market's expecting, are for a 3/4 point interest rate hike next week. That seems to be all but done with Powell's comments and then what he said since then. They seem to really be sticking to their guns as far as rising interest rates or hiking interest rates as much as needed to help fight inflation. We're looking at November, and it's a ways off. A lot could change. We're kind of looking at a 0.5 point interest rate hike then, and then in December, just a 1/4 point interest rate hike, which again, a lot of things could happen. So there's a lot of eyes on the CPI reports, and the Fed actually watches the PCE, personal consumption expenditures, a little more closely. But regardless, we're looking at an upper bound of the federal funds rate at 4% at the end of the year. Currently, at the beginning of the year, it was at 0.25%. So obviously, we've seen a lot of interest rate hikes this year, and we expect those to continue into next year with inflation still running at 8%. Let's say that it does back off, and this is what a lot of people are watching, is the concept of peak inflation, where has inflation hit its peak, and is it kind of headed downwards? It seems like that could be the case, but it still is elevated. That Fed funds rate doesn't necessarily have to match inflation, but it has to show that it's bring it down to what's considered, or the Fed considers to be their comfort level, which is 2 to 3%. And so even if inflation, which has been running around 8%, were to fall to say 7 or 6 or even 5%, that's still above the Fed's comfort level. So it looks like they're most likely going to continue raising rates for the foreseeable future. The higher they raise rates, the more growth will probably be stymied, leading to a recession, probably sometime next year or the year after, if that is the case. Some of the catalysts that we're looking at, the market catalysts going into the end of the year, obviously inflation, what the Fed does. Employment's a big one too. Employment has remained very high. Unemployment's remained low, which is just kind of an oddity given everything else going on in the market. And if unemployment remains low, then it causes pressure to wages, which in turn leads to more inflation. Consumer spending as well, like I mentioned earlier, that remains intact. It's a good sign for the economy overall. So we're keeping an eye on those things. And then obviously the midterm elections in November, the market tends to not like uncertainty. So regardless of the outcome, I think we'll start to see a bit of a market rally kind of coming into the end of the year. It really depends. I mean, if there's a big swing one way or another, it could be a push for the markets in one direction or the other, depending on that. But we'll leave that conversation and kind of our thoughts for another day. So now talking about our scorecard that we want to roll out and show off. What this is meant to do is determine if you are on track to meet your retirement goals. We're taking a deep dive into a series of questions. As we talk to the families that we work with, we try to identify areas that might need some attention to make sure everything's covered. Hopefully the people that we've been working with for a number of years are feeling very secure in their retirement. As we go through this scorecard, they're scoring out in a very positive manner and with getting higher grades, kind of like going back to school, with school starting here last week for a lot of people. This is like going back to school and getting your own grades. And so what we do is we review 5 key areas of retirement planning: our income, investments, taxes, health and long-term care, then our estate planning and legacy. And we take a deep dive. And let's take a look at an example. So this is our income planning. What we would do is get into some of these questions, make sure that you, for example, have a document and plan in place for your income planning, to make sure that it's been statistically, historically, and mathematically tested, to make sure that it's robust. We talk about Social Security, for example, lump sums and pensions. But then we also look at debt levels. So this is just the one component of our income planning. So as we go through these questions with you, we would sit down and make sure. And a lot of times people think that they might have something in place, but when we start to dig into it a little bit deeper, we find out that there may be some gaps. We want to make sure that your planning is absolutely complete and there's not anything that is incomplete. So as we work through these, there's almost like different modules. So we answer it's yes, no. Sometimes it can be not applicable. There's some analytics behind this. So it's not a simple, there's 10 questions, you miss one, it's 90%. Some of these are weighted a little bit differently than others, because we think that they have a little more importance. And so we give, and after looking at all the answers of the questions, then there's an overall score as a percentage. But then we also take a look and say, okay, is this excellent, satisfactory, or is there, we'll call it incomplete, or there's obviously some holes. In some cases, people might be happy with the satisfactory and think, okay, we've done all that we can. There's no reason to do more. Obviously, if it's an excellent, there's nothing else that needs to be done. If it is incomplete, there's room for some improvement, and that's where we can help you hopefully push that score up and help complete your planning. And then as we work through each of these, we give an overall grade and an overall report card. Again, there's a percentage here. We look at excellent, satisfactory, or incomplete, with excellent being doing about as well as you can. Hopefully scoring out at 100% or close to it. Satisfactory means it's good, but there's some things that you can do to improve. Incomplete means that there's more focus needed. And, as many of the families that we've worked with know, our process isn't we sit down all at once and do it. This takes time, and it's a matter of time as we work through each one of these. And in this case, we'd work through these modules probably in a single meeting. So it might take a while to eventually get there to work through each one, and maybe we don't fully evaluate one until we get to that point, or we really focus primarily on some of the things, some of the most important things first, such as the income and tax planning. And then as we go down the road and work with you, we focus more on the health and the family and legacy planning. We also take a look at your risk score to make sure that it's appropriate for you. We use a vendor called, or a third party, we should call it, that we partner with called Riskalyze. What they do is they develop a risk number anywhere from 1 to 99 to show you how much risk you're taking in your portfolio. We want to make sure that that's appropriate, not too high, not too low, kind of getting back to the Goldilocks analogy. If you are taking on too much risk, as we've seen in the market this year or in past years as well, you really open yourself up to a lot of to the risk of loss. And if you have an income plan that's predicated on a certain asset size, and then that asset size is no longer there and you're withdrawing money, it obviously could negatively impact your lifestyle in retirement. So we want to make sure that you're in the right spot there. And then lastly, this is something, we really focus more on the scorecard that I'm showing you with the scores, but this is something that we can do for you as well. Just sit down and take a look. I mean, a lot of you that have worked with us for a while are aware that we do Social Security analysis. We look at different scenarios. What would it mean if you took Social Security as soon as you could? What if you took it as late as you could? Or what we like to aim for is an optimized Social Security. So we take it at the best time, which, if you have two spouses, there's some planning that goes around that. It might make sense for one of you to take it early, one of you to wait. We do look at the portfolio risk, and we can look at, what a current portfolio, what the loss might have been in different scenarios, such as the financial crisis, 2007, 2008, going back to the dot-com bust in 2001, interest rate hikes that we saw in 2013, and how if we were to reduce your risk, what that might mean as far as less loss in the portfolio. And I think most importantly, though, is the tax analysis. As we take a look at, your IRAs and what you're probably going to end up paying in taxes when it comes to RMDs and withdrawals to support yourself throughout retirement, what the tax implications of that are, and what we can do to help you reduce those taxes, not only to yourself, but also to your heirs, and what that tax savings might look like. And as you can see, and these numbers, are hypothetical. These are not based on anybody in real life. That it can be a pretty substantial number. We're talking hundreds of thousands of dollars. So this is some of the value that we can create, or are glad to show people what we can do for them. And lastly, as we wrap things up here and open any questions or comments anyone may have, so feel free to use the chat. We are Market Huddle next week. We will be looking at 5 ways to squeeze more money out of your IRA or 401k. We'll have one of our advisors going through that to talk about some of those strategies. So something to look forward to a week from today. Then looking out into October, so about a month out, here on Thursday, October 13th, we are doing our TaxSmart Retirement Summit with Becky Ruby Swansburg. She's a partner of ours that we've worked with for a number of years at Stonewood Financial. She's obviously a expert when it comes to retirement planning, but she began her career in Washington, D.C., working in communications with Congress, and she worked in the George W. Bush administration. So she really has an insider's view. She can talk about some of the legislative risk that we're facing today, and it's something a lot of people overlook, is they think that these tax rates are going to stay the same, but there's a lot of risk with what Congress or a presidential administration could do that could have a big impact on the taxes that you pay into retirement. So if you haven't registered for that, contact us and we'll get you on the list. We'll get tickets for you, and obviously invite your friends or family, anybody that you think would be interested. We're looking forward to that. And as always, we're here. So if you have questions, don't hesitate to give us a call if you want to talk about your account or anything that we've mentioned today. If you want us to go through the scorecard with you and put one together, we'd be glad to do so. So I guess last call for questions. I don't see anything in the chat, but everybody. All right. How do we get the TaxSmart review? Well, give us a call. Here's our number, the 460-3260, 952-460-3260. You can email us at info@securedretirements.com. Um, if you are working with one of our advisors currently, please reach out to them directly too. They would be glad to do this for you, and reach out to me. All right. Well, I don't see any other questions out there, but if any of you do have questions after the fact, please don't hesitate to give us a call. Appreciate everyone hopping on today. And thank you all, and we'll talk again soon.